Loan Officer Training Series with the Mortgage Calculator. Today we're going to be talking about preventing mortgage fraud. So we'll wait just a minute here to get started. Let us go live on all the different platforms. But we appreciate everybody tuning in nice and early. We put the chat up on the screen. Feel free to drop a comment there in the chat as you tune in. And we'll get started here in just a moment. Thank you for the comments I already see coming in there. April, Oscar. All right, Oscar, I hope you're doing good. All right. So, good topic here for today, and definitely some good housekeeping stuff, but don't sleep. This is stuff that we definitely need to know. So, we'll get into it here in a second. Keep dropping comments there in the chat, and feel free to drop any questions you have as well as we go through the presentation here today. We're just waiting to go live on all the different platforms. Remember, we do stream this live on YouTube, Facebook, LinkedIn, Spotify, Apple Music, anywhere you can get a webinar or a podcast, we are there. So let us go live here, but I appreciate all the comments coming in. All right, so it looks like we are good to go. We'll go ahead and take the chat off the screen for now, but keep dropping comments in there and ask any questions you have as well. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president Nick Hershey and our sales manager Jose Gonzalez. What we do is every Tuesday and Wednesday night on this webinar, we do a loan officer training. So we are a correspondent lender and we specialize in non-QM loans. Some of these trainings are on non-QM loans. Some of them are on different topics. And today's topic is a little bit different than what we usually do because we're talking about preventing mortgage fraud, almost some compliance stuff here, but there's some good gems here that Jose is going to drop on us. So Jose Gonzalez, our sales manager with 28 years of experience as both a realtor and a loan officer, is going to talk to us about preventing mortgage fraud. Great time for the topic, right? We're all doing our CE, our continuing education. Make sure you all get that done here. So Jose, let's talk about it.
All right. Good evening, everybody. Thank you for joining us for tonight's training. This is very interesting training because it basically goes hand in hand with tomorrow's training that's about ethics, right? Ethics, mortgage fraud. Yes, I just did my CE too, so a lot of a lot of the things I'm going to talk about were very fresh in my mind. But mortgage fraud, very important to combat mortgage fraud in the industry as a company as well, because not only does mortgage fraud affect the industry, because fraud will increase the costs for lending, but it can also cause the demise of a company, depending how deep that fraud is, who were the participants, and what is the end result of what has to be paid back, right? So, and it could also end many careers. So, very important that we understand how to identify mortgage fraud, how to prevent mortgage fraud, um, because definitely we want to be always to provide the best experience for our borrowers when we're looking at it from the point of view of a lender and a loan originator. As you all know, we have a fiduciary responsibility to our borrowers, have to look out for our borrowers' best interests, and also for the best interests of the organization who we have our license with and for our own license. You could be, without knowing, you could unknowingly be sucked into some mortgage fraud. You may be unknowingly complicit, uh, but possibly due to your, I hesitate to say, but due to your ignorance of the matter, may make you complicit to the mortgage fraud. And then you're going to have to do a lot of explanation to the regulators to keep your license and stay out of jail. So let's get into it right now. So, what is mortgage fraud, right? Well, it's deliberate deception from a borrower, lender, or insider to fund, purchase, or insure a mortgage. Now, there are two primary categories for mortgage fraud. There is fraud for housing, which tends to be committed by borrowers, typically borrowers wanting to get into the home who may not qualify for the home and may be unfortunately willing to do all types of mortgage fraud to get the home, which can include misrepresenting income, misrepresenting assets, or manipulating an appraisal, or all three. Uh, Fraud for profit tends to be committed more by insiders like loan officers and other people in the biz, and tends to occur by manipulating the loan process to benefit illegally, right? So that could be uh, inflating the income so that the borrower qualifies. The borrower may not even know what's happening, just so that you can get paid and get a loan because you are desperate for money, right? So there's a lot of unfortunate reasons why um, fraud for profit would happen, but just be aware that they're divided into two categories: fraud for housing, which tends to be committed more by borrowers, and fraud for profit, which tends to be more insider transactions. I guess you could compare that to like insider trading. So let's get into some of the types of mortgage fraud. I have this spread out amongst a couple slides here. The first would be occupancy fraud, which tends to be one of the common fraud for housing uh, types of fraud, where a loan applicant deliberately misrepresents their intended use of the property to get a lower rate and or a higher LTV. And this could be, for example, the borrower that says that they're going to live in the property, that it's going to be a primary residence when it's really going to be an investment property, because primary residences can go as high as 100% LTV, depending on if you're looking at a VA loan or a USDA loan. Imagine that, as opposed to your investment property, which in a best case scenario is going to be 85% LTV. So you can see the rationale there. Straw buyer. Now, we're not talking about like a scarecrow made out of straw now there. We're talking about an individual who applies for a mortgage to buy the property on behalf of someone else, right? They're stating they're going to be the occupant of the home. They're going to be the ones financially responsible to make the payment. But in actuality, there's somebody else who is behind the scheme, somebody that probably has bad credit. Maybe they're on some type of undesirable list, because fraud guard does get run on these loans. And if you come up on one of those undesirable lists, like the OFAC list, they're not going to lend you the money because you're already proven to be a high risk individual. So, and in some cases, the straw buyers are doing it for the money, right? And in some cases, they may not even know they're a straw buyer because their ID could have been stolen and somebody else is the straw buyer using stolen identification. Income fraud, that's the one that we probably are the most familiar with, is when either the borrower, the mortgage professional, or both, like I was just mentioning, the mortgage professional, report inaccurate information to get a better deal or a bigger loan, or just to be able to get the loan that they may not qualify for. The fraudulent pay stubs, W-2s, fraudulent employment, and all those other kind of things that could occur with income fraud. Now, asset rental fraud. This is one you may not be so aware of, but it is definitely out there, where the borrower actually may rent or borrow assets from another individual to appear more qualified than they really are. And once the loan closes, they return the rented or borrowed assets to the individual who they got it from. They may have also paid a fee to that individual to use their assets. We have home appraisal fraud, which occurs when the value is inflated way beyond its actual value and is particularly common in property flipping. Now, I'm not talking about a legal flip where you purchase the home, you rehab it, and you sell it. Here, property flipping is where the home is sold very soon after it is purchased. Um, and it usually involves buyer and seller colluding on the transaction, fixing the price. There was a lot of that going on in the prior, before the crash of 2008. A lot of colluding, groups of individuals that were just buying and selling the properties amongst each other, and in most cases employing an appraiser that was in on it as well to facilitate the price, and they were obviously all benefiting from all of that fraud. And expanding on property flipping, which is part of home appraisal fraud, is when the property is bought below market value, immediately sold for a profit without any renovations, using an inflated appraisal. Then we have equity skimming, which is a buyer purchases a home with the sole intention of renting it out without making mortgage payments. Now, that is usually going to be also accompanied by identity fraud, right? Because the reason you have no intention of paying it is because it's not really you. And when they go to foreclose, you're gone. And when they go to look for you, you're nowhere to be found. And usually, those foreclosures in some of the states that are judicial states can take a year, 2 years. In the meantime, you're collecting. And by the time they foreclose and they realize what happened, you're long gone with the money. So, what are some of the red flags that we can have? Well, I'm going to break it down here general, and in the next slides, I'm going to give you some more detailed information. But when you're in the application stage, right, you should be aware of inconsistencies in the personal information, right? You're reviewing the docs. Some of the docs don't have the same information. You may have different dates of birth, different place of birth. I mean, just inconsistent personal information, which you as the MLO are going to be reviewing as part of the process. This personal information could include also unusual employment history, right? Just whatever it could be, something that just doesn't add up to what this person could be qualified to do. And we're not asking anyone to be judgmental on anyone, but this is just part of being aware of what's going on. And if you have any suspicions, you're not going to accuse anybody straight out. You're just going to do a little bit of investigation. Real important is alerts in the credit history. This one also goes hand in hand with inconsistencies in the personal information. We reviewed that the other day when we were talking about reviewing credit report information, but here we're looking at it from a different point of view. Previously, we analyzed it from the point of view of how it's going to affect our credit score. Here, we're going to review it as in, could this be fraud? If you have a credit report with a borrower with multiple dates of birth, multiple different addresses where they live, addresses reported where they live. Now they may have 3 or 4 addresses that are concurrently being reported as their current address. That could be a little weird. Name mismatches or any other kind of alert on the credit history. And then obviously we have the fraud alert on the credit history. That's a more obvious one, where an individual has previously suffered some type of ID theft or other fraud against them, so they have a fraud alert on their uh, on the report, in which case you have to verify that they are who they are and that they are the ones actually that are initiating this transaction and not some fraudulent third party fraudster. Now, during the underwriting stage, and we pre-underwrite our files ourselves as MLOs, right? But as well as the underwriter who's going to be reviewing the same information as us, look out for suspicious income documentation, right? Does it add up? Or do the check stubs look legit? Are they handwritten? Do the Are the tax withholdings accurate? I mean, if you see a huge income and you see low withholdings, it could just be that they just changed the income part and kept the withholdings uh, the same as for their lower actual income. Right? Is it an unusual property appraisal? And I'm going to get into some more details on some of these, but is it an unusual property appraisal? This is one of the reasons why you sometimes have to be concerned with a transferred appraisal. For example, borrower who insists adamantly on wanting to use a certain appraisal, and it may not necessarily have to do with the fact that it's going to cost more money for an appraisal, especially if, for example, you offer to credit them for the appraisal that and they still insist that they want to use that appraisal. You may want to review that appraisal a little more deeply and ensure that there isn't any funny business going on. We have situations where we have undisclosed liabilities, either, and is usually going to be revealed by fraud guard. All of a sudden, fraud guard reveals some undisclosed properties that probably have some undisclosed liabilities, or they have some undisclosed liabilities that were found for properties that were disclosed on the application. Those That could be a simple oversight, or it could be malicious intent there. And during the closing stage, some red flags could be unexplained delays or rushes, like the borrower all of a sudden disappears for a while, nowhere to be found. I mean, hopefully they didn't pass away or they're not in jail. But if they're just avoiding you or ghosting you, and then all of a sudden come back, they're just be on the lookout that they may have just been scheming. Same with somebody who just wants to rush to that closing with no apparent uh, reason that they can provide for the urgency. They could just be worried that whatever scheme that they're doing is going to be found out, so they want to close and they want to get that money in their hot little hands before the cat is let out of the bag. Altered closing documents could be another one. That could be actual closing documents or IDs, anything involved with the closing process, affidavits, warranty deeds, any kind of documents that they may have been providing to the title company to confirm certain details. Now all of a sudden, title company tells you, "Hey, we got a problem with this document. I checked public records on the filing number of the document, and it's not a real number. That number doesn't coincide with what it should be for the date when that document was supposed to have been recorded." So you have a potential situation there. And unexpected changes in loan terms, right? Like they were doing investment, and now all of a sudden they tell you they want to change to primary or second home. That could be a big red flag. Now, giving you a little bit more detail specific to our more common fraud items. So for occupancy fraud, be on the lookout for appraisers that include expected rent payments on the appraisal, right? It's not a actually received rent payment, but they're uh, bumping up the income with an expected amount, which is not in compliance with guidelines. Buyers who provide evidence of living rent free in their own residence, and very large down payments. Now, why the very large down payment? Well, because in some cases that could be being funded by the person who's actually going to live in the property. Some red flags for straw buyer fraud. Remember, the straw buyer is the individual that's putting their name and information, credit, and income potentially for somebody else whose information is probably not going to meet, allow closing of the deal. So be on the lookout on transactions where the funds may be coming from an entity or institution. Now, obviously, if we are doing an investment property DSCR loan, like the ones we love doing at the mortgage calculator, and our borrower is closing in an LLC, and the bank account is from their LLC, that's not what we're talking about here. What we're talking about here is they're giving you statements from some LLC or entity that they may not have an ownership interest in. So, we would definitely want to verify any of that information. Now, if there is a lack of any interaction between the lender and the buyer, you got the buyer, because normally, buyers are all over it, right? Borrowers, they are all over the transaction. But if you have one that seems a little bit aloof, not really caring too much about it, just doing whatever, just look a little bit deeper and make sure that they're the actual buyer, because the straw buyer isn't really going to care, especially if they're getting paid and they're never going to live there and they're not making the payment. All they did is just sign the application and provide documentation. So you have to be aware, if you do have a borrower that is MIA like that, that could be a straw buyer. And when your post closing tracking shows that the property title has been transferred shortly after the sale, the actual buyer transferred it out of the straw buyer's name into their name. Mind you, the loan and the note and the mortgage is still the responsibility of the original buyer. Now you have a potential scenario there where if this gets found out, you probably may have an accelerated mortgage just due to the fact that they transferred the uh, property into somebody other than the borrower, because the person who's behind the whole scheme, they are not going to feel secure unless the property is in their name, especially since they put the money. They probably do not care that if the bank finds out, it could cause the bank to foreclose because of the due on sale clause. Non-arms links transactions. I'm not going to say a non-arms links transaction is fraud, but if you have a non-armed links transaction, and a non-armed links transaction is when the buyer and seller know each other, right? They're either related by blood or by work, it's like their employer, or for example, it's their landlord. Those are all cases of non-arms linked transactions, right? The issue with a non-arms links transaction is if it is undisclosed, right? Because you will all be aware that in page 4 of the 1003 in the declarations, one of the questions asks if there's any relation between you and the seller of the property. You're gonna have to put yes or no, and if you put yes, then you got to explain what the relationship is. you know what they talk about these things, right? Disclose, 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 and all of these situations where there could be any type of collusion, possibly. We want to make sure we disclose all of the relationships. But if that non-arm's links transaction, if you find out that it's undisclosed, then we really have to research this to find out if it was just a mistake, like they checked that box incorrectly, or is there really some collusion going on? Because non-arm's length transactions are highly susceptible to manipulation, especially if they are not using a real estate agent. So if you do have a non-arm's length transaction and they are selling it amongst themselves, not a listed property, not using a real estate agent, then you really have to examine that transaction and make sure that there is no funny business going on. Now, for a property flip fraud, and again, we're not talking about a legal flip, which we love because we have plenty of fixed flip loans at the mortgage calculator, and then we have plenty of options to refinance that investor, the flipper, out of the rehabbed property into the end loan so that they can rent the property and happily make their rental income. So that's not the property flip we're talking about here. I don't want to upset any of our property flippers out there, our legal property flippers. But on a property flip, if you have a middleman or straw buyer that is being used, they can often be the flipper who's providing the fraudulent appraisal. Other indicators for a fraudulent property flip is a property that was recently in foreclosure, right? A foreclosure bailout is really what we're talking about here, also. Or a property that was acquired at an abnormally low price, or a property that the appraisal value is being suspiciously inflated. So if that's the case, if it doesn't add up to what it should be, we have to look deep and ensure that there is not any fraud going on between the buyer or borrower, seller, and the appraiser. Income fraud. Now, this is the one again that we are most used to seeing. Pay attention to major discrepancies between the borrower's life experience and their job title and income. Investigate to ensure that the listed employer is a real business with a verifiable location. Review the pay stubs for inaccurate withholding and other information, especially handwritten pay stubs, right? Handwritten pay stubs. Um, Other things you may want to be on the lookout for when you're looking for income fraud would be things like undisclosed divorces, right? Fraud Guard is going to pick up if you're divorced, but let me tell you something that can also pick that up: pay stubs that have child support or alimony payments on them, where the borrower just didn't disclose it on the application, hoping you wouldn't catch it, and then you catch it on the pay stub, right? Or vice versa, a pay stub that has none of that information. Borrower doesn't disclose anything about having any dependents or anything like that, and then all of a sudden, Fraud Guard discloses that the borrower is divorced. So at that point, you have to be asking for divorce decree, property settlement agreement, and a good reason, very good letter of explanation as to why that information was left out. Usually, it's going to be because they're paying a lot of money in child support and or alimony, and were that information included in the application, in the liabilities as it needs to be, the borrower would not qualify. So an omission of information like that is definite income fraud. So income fraud isn't just beefing up the pay stubs and the W 2s, it's also omitting information, which is going to increase your liabilities and possibly put your DTI over the threshold. So, what are the best practices to combat mortgage fraud? Well, the first one, you all are doing it tonight, right? Training for mortgage professionals. Pay attention also to your continuing education because there's a lot of good stuff in there about mortgage fraud. Report suspicious activity to management and compliance and the authorities, right? Police and other governing bodies. Utilize technology and data analytics. Implement strong internal controls. Regular reviews and audits. That's what the regulators are going to do. And implementing strong internal controls would be our compliance department. Collaboration with industry and regulatory bodies. Fannie, Freddie, and the other GSEs have very good protocols for fighting fraud. So if you do suspect some type of fraud, it's not a bad idea to reach out to them, explain to them what you think may be going on, and they have many resources and much guidance that they can provide because it's in everybody's best interest to combat fraud. We want to encourage vigilance and proactive measures from everybody involved in the loan process. Like they say, if you see something, say something. Don't stay quiet. Let it happen because it is definitely affecting you. It's not just affecting whoever the fraud is being perpetrated against. Because we all suffer from the damages caused by fraud because fraud increases costs to all businesses involved in the transaction. And when the costs are increased, the only way to cover those costs is to increase the income. And for lending institutions to increase income, they have to increase the margin, which is going to increase the interest rate. So you can see how we can all contribute to keeping expenses and costs down and keeping interest rates down by doing our part. And last but not least, and this is one of the one that definitely applies to us at the mortgage calculator and why we always train our mortgage loan officers to be loan consultants and is work with a reputable lender with an established track record. More the reason why tomorrow we're having ethics training for our loan officers because we want everybody out there to know that when you do choose the mortgage calculator to fund your loans, you are working with loan consultants who are looking to combat mortgage fraud and who have a very high level of ethics.
All right, great. Well, I don't see any questions in here.
I took some notes. Hold on, I want to say.
Oh, go ahead. Go ahead.
So, just a couple things that I hear well, not every day, but from directly from customers a lot of times to look out for, especially they're kind of popular topics on Facebook and Instagram and stuff, right? So Jose mentioned it a little bit, but there's a whole bunch of people that talk about subject to financing and some of the creative financing strategies, which in themselves may not be illegal, but just be aware, as Jose mentioned, if you change title vesting in any way, shape, or form on 99% of mortgages, you're going to accelerate the mortgage, aka the mortgage is no longer valid, aka the mortgage is due in full that very day that you changed the vesting, right? You violated the legal instrument, not necessarily the law per se, but you violated your mortgage, right? So be very careful there. Obviously, we don't want to recommend customers to do that strategy. And when they come to us trying to exit that strategy, it becomes very difficult because they can't prove that they are actually fully entitled owners and that they have made, most importantly, right, Jose, 12 mortgage payments, right, which is going to be the deal killer. So be careful when people get sucked into some of those strategies, which sometimes are very valuable, but do become very difficult to finance and could be a gray area, right? These are kind of gray area strategies that investors do like to use, and they often ask questions about it. Another strategy that's a very gray area has to do with undisclosed financing. So a lot of investors want 100% LTV. It doesn't exist, right? There is no such thing. There never will be such a thing. Maybe back in the days, Jose got very creative when, pre-crisis, pre-laws, right? But we all have to follow the laws now, which there will be no 100% financing with the laws the way they are, especially for investment properties, which is the typical request. Therefore, people try to have undisclosed seller financing or undisclosed some kind of commercial financing. Remember, we need to look out for that. It is not valid. I wouldn't necessarily say it's illegal, but it is part of fraud. It will cause our loans to be invalid. If we're sucked into that, we could be sucked in, as Jose mentioned. And the same thing with borrowing money for down payment. So a lot of people think that's okay. It could be okay, right, if you eventually pay the down payment, but the down payment has to be proven for every loan, right? We have to prove that the funds came from the borrower and that they're theirs. The other thing that is popular on some of these investor groups, and I would say more of the wholesaling and flipping groups, is to use other people's assets. Remember, Jose mentioned that's expressly illegal, right? You can't use LLC that someone else has. A lot of investor groups like to use this. One person has a bank statement with $1 million, and everybody wants to use that bank statement for a loan. That just is not legal, right? So we don't want to be involved in that. Definitely let your customers know that getting creative is a great strategy, but it becomes very difficult for us to help them if they sometimes undertake those, I would say, gray area strategies, right? We're not the law, right? We're not going to say it's illegal necessarily, but that becomes very problematic when we're trying to prove that there's no fraud going on, because those are somewhat going over the line, right, Jose? I guess, do you want to comment on any of those items?
Yeah, that last one is the one I was hoping that you would comment on, because that's one that we've discussed quite a bit, and yeah, that's definitely very illegal. So no, those are all great points that you brought up. Oh, and the one that you mentioned about 12 months, that's relating to occupancy fraud, when somebody is buying a property as a primary or as a second home, and then they convert it to an investment property where they're never going to live on the property, where there's always going to be a rental. Be aware that the mortgage, because you got two items. You have a note, which is the promissory note to repay, and then you have the mortgage, which is the hypothecation agreement that has the terms and conditions under which you will be allowed to basically stay in the home. And if you violate any of those clauses, the financial institution that holds the lien on your property can foreclose on the lien for a violation. And one of those is the due on sale clause, right? So if that's one of them, and the other is occupancy. You were mentioning about switching the title out of the vesting out of your name. That will cause the due on sale clause to be activated if they find out. And the other one is that if you transfer if you move out of the home less than 12 months and you rent it out without refinancing it into an investment loan, you have committed occupancy fraud.
All right. And something like that, some people might not think of, right? I mean, something as, yeah, I bought the house, but then 8 months later, I decided to turn it into a rental property, but that can kind of catch up on you there. So these are all great things to know. All right. Well, again, I don't see any other questions, so we'll go ahead and wrap it up. Remember, Jose was saying that tomorrow we'll be doing the ethics training that kind of goes hand in hand with this. So remember, Tuesdays and Wednesdays, 7 p.m. Eastern, we always do these. So tomorrow will be another good one. Thank you, everybody, for tuning in. We appreciate it. Thank you, Jose. Great presentation. We'll see you all tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, everybody.
Thank you, everybody.